Hey, Andrew here from the Investor's Way, and welcome to Woody's Weekly Wisdom, episode number 70. And today we've got a brief but really important weekly wisdom video to share with you. And before we dive in, really massive ask and favour. I'm really trying to grow my YouTube channel and the number of people who get to see these weekly wisdom videos, so that we can spread the news. So if you are watching on YouTube, hit that subscribe button and the little bell to get notified when we put out a new video. And if you're watching on Facebook or LinkedIn, then do me a favor, hit the like button, share a thought. What do you think about these videos? What topics do you want me to cover? Feel free to share any of those thoughts as well. And if you really want to do us a massive favor, hit the share button, and that will send it out to people in your network, and more people can benefit from the information that we're sharing on these weekly wisdom videos. So this week I'm doing something really, really different. I haven't done it in this format before, but I want to focus on these two stories here. And as you can see, they've both got the exact same image, and they've got two very different headlines. So the first one says, Aussie shares rise on Wall Street rebound. So that's positive. That's great. The shares are going to rise. And then we've got Aussie shares sink on China stimulus gloom. So if you've been around for any length of time, you'll know how much I despise the headlines that try and give us a reason why the stock market's going to do one thing or the other. Because in reality, from day to day, all of this is just noise. And I'm a huge proponent when it comes to investing in the stock market of doing it for the long term. And if you look at any long-term graphs of whether it's the Australian market or the US market, you will see that over a sustained period of time, they just keep increasing. And that makes a lot of sense because both in Australia and here in Australia and overseas in the US, there's lots and lots of money getting poured into the stock market from retirement accounts. So in Australia, we've got the compulsory super guarantee scheme, and as a result, that money coming out of our wage or coming out of our total package is got to go somewhere, and it goes into super funds, and ultimately it goes into the stock market. So with trillions of dollars a year or billions of dollars a year, depending on what scale you want to look at it, it's coming into these super funds or into people's accounts, self-managed super funds, and it needs to go somewhere. So it's pouring into stock markets, and as a result, that's causing markets to grow, and therefore share prices grow. And so over the long term, sure, we're going to have our ups and downs, but the long-term projection for the stock markets is that they will continue to grow. And so if that's the case, why do we need to get hung up on what's happening from day to day? And the simple solution to this is we don't. So if you come into my world, one of the things you'll learn very, very quickly is that we don't want to be looking at our stock investments every single day. And even more so, we don't want to be looking at them every hour during the day, which some of my clients admit that they have done, but we do try and encourage people not to do that. And these two articles are a really great example of why that's the case. Aussie shares rise on Wall Street rebound, Aussie shares sink on China stimulus gloom. Now, I am going to point out this article about China stimulus is in relation to Tuesday, and this one is in relation to Wednesday of this week. So I get it. They are talking about two different days, and Tuesday market went down, Wednesday market's expected to go up. It just shows, however, how fickle the news can be about what has caused the markets to do whatever it is they're doing. So if you think about the stock market, it's made up of, so let's just talk about the Aussie market, because these articles are talking about the Aussie market. It's made up of Australian companies that are operating in Australia and globally and selling their products or services and trying to generate profits. And so if the US stock market goes up, overnight, for us Australians, why would that impact what's going to happen with the profitability of Australian stocks, or more particularly Australian businesses? Like, they're going to wake up today and go about doing their business just like they did yesterday, and it's going to have very little impact. What happened on Wall Street is going to have very little impact on the results that they produce today from their business. So these kind of statements about why the stock market's doing what they do is just noise. And yeah, sure, the stockbrokers or the traders and stuff like that who are looking to make short-term profits, they might go, okay, Wall Street went up overnight, so Aussie's got to go up, so we're going to trade the market up higher today. And that probably happens. But if you're a long-term, capital growth, income-producing investor, you don't care what happened in Wall Street last night and what impact it might have on the stock market today. Unless, we've got a massive crash caused by some outrageous event, then sure, you're going to look at that with a little bit of trepidation, but you could probably also look at that and say, well, this is just an opportunity because it's a massive overreaction. And we've seen that multiple times. So COVID of recent times is a really good example where the market dropped, around 20% in a week because of everything that COVID was producing for world economies. And within a month, as everyone had gotten used to what that meant for the world, the stock markets had pretty much recovered all of that 20%. So big crashes like that tend to lead to opportunities, and they certainly will create a great deal of headlines for the media. We saw it also just in August, where the markets dropped about 6% in 3 days. And sure enough, within a month, they were well past that 6% and heading higher. So I want you to see the irony, I guess, of these two articles being right next to each other, and one saying we're going up on the Wednesday, the other one saying we went down on the Tuesday because of China stimulus gloom. And again, when you look at that headline, you go, the shares sunk on China stimulus gloom. So the fact that they say gloom probably indicates that there was no confirmation of stimulus changes. It was just doom and gloom about whether or not the stimulus would be continuing or not. But without the confirmation, they couldn't say that it was for certain, so they just called it gloom. And so allegedly, Australians woke up that morning and said, oh, look, the Chinese stimulus, it's not going to be there. That's going to have a big impact on our stock market that relies on the Chinese market, so we better just sell the stocks down today because they're just not worth as much today as what they were yesterday. But ultimately, like I said, that's just a whole lot of noise. And seeing these two articles right next to each other with the same image is just, to me, it's funny. But I get it. They've got to create a narrative. They've got to create some stories about why the stock market's doing what it's doing. But as an informed investor, I want you to look at this and see it as a classic example of why we don't look at the stock market every day. Imagine your emotions and your decision-making if one day it's doom and gloom, the next day it's rebound, and then the next day after that it's doom and gloom again. Your emotions are going to be all over the place. You're going to make irrational decisions, and you're going to impact your results negatively because you looked at this stuff as being a guide as to what to do. Let all the not the doom and gloom, let all the noise happen and just build your portfolio for the long term, and you'll get far better results over the long term. So hopefully that's helpful. Like I said, a little bit different this week. We're not actually diving into the articles to see more about what they're talking about because we don't need to. In this episode, we're just looking at the headlines and seeing how ironic it was when you put two headlines 2 day, 1 day apart effectively, and the extent of emotional turmoil that they can cause if you just if you're one of those people that scans headlines and goes, oh look, stock market's down today, and then the next day it's back up again. You're going to form these erratic mindsets around the performance of the stock market. And I see that all the time. People are so fearful of the stock market because all they hear is the doom and gloom or the negative headlines. And not so much that stock markets just day by day they just tend to creep up, and then they have the big falls and then they just keep creeping up again, and that's what we don't hear. And people therefore all they hear is the big fall, the doom and gloom stuff, and they get fearful of the markets. And here's a great example of why that can be the case. So hopefully that's helpful. As I said, a little bit different this week. But it's a great example of why we want to take emotion and noise out of our decision making so that we can make much better, profitable investing decisions. And that is my desire when I do these weekly wisdoms, is to give you that impetus and just expose some of the stuff that is happening, some of that noise, so you can recognize it and then move it to the side, ignore it, and invest for the long term and the long-term growth of your portfolio over the long term. So, as I said, hopefully that's helpful, and let me know in the comments. And like I said at the beginning, let's grow the channel on YouTube. So if you're watching over there, hit the subscribe button. And if you're watching on other social platforms, leave us a comment, hit the like button, and smash that share button and let other people see what we're talking about so they can benefit as well. Have a great week. See you again next week. Cheers.